Hi, this is Vinod here. In this video, I will explain why the human brain is not good at investing or trading decisions. Now, there is a field of science called as behavioral science or behavioral economics that has found out that the human brain operates in two different modes. It's called as system 1 or system 2. It's called system 1 thinking or system 2 thinking. Now, system 1 thinking is the most common one. It is fast, automatic, and intuitive, and it's mostly driven by instincts or emotions, and it's responsible for us to make any quick judgments or any decisions without any conscious effort. Now, most of us operate, or in most of the quick decisions that we make using our system 1 thinking. But for more deliberate, analytical, or more conscious effort, we switch to a different mode called system 2 thinking. Which is more slow, deliberate, and analytical. The system 2 kicks in when we are involved in a conscious reasoning, analysis, when we are doing any complex computation. Now, when it comes to investing or trading, the most beneficial mode is the system 2 thinking, which is more slow, deliberate, and analytical. But what happens is that when money is involved and when we are involved in making any financial or investing, trading related decisions, sometimes the system 1 takes over, and it usually results in us making decisions which are counterproductive or actually negatively affects our investment returns. Now, let me explain this with an example or an experiment that was conducted earlier. Now, imagine this scenario where you have two investments in your portfolio. One is a profitable investment and one is a losing investment. And now if you're given the choice to decide between these two investments, to sell one of them to raise money, what would you do? Most humans, when they ran this experiment on humans, and then they found that most humans are comfortable selling their winners while they are not comfortable selling their losers. The brain is not comfortable accepting a loss. I will tell you why this is an irrational approach. Now, selling winners and holding losers. So the brain is okay to book profit. They are okay to sell their winning trade, but their brain refuses to book a loss, or our brain tries anything to refuse accepting a loss. Now, why is this irrational behavior? Now, let's look at what is a more rational approach. Now, the rational approach would be holding on to our winners while booking the loss, while selling the losing trade to book the loss. Now, why is that the case? Why is it more rational? Now, holding on to our winners gives us a chance to maximize our profits. We are already in profits. We are also giving it a chance to get even more out of it, like try to maximize our gains from our winning trade. Now, I'll tell you why selling a loser is also a rational decision, because when we sell a losing trade, it limits our loss. But when we refuse to take a loss, what we are doing is that we are actually maximizing our loss, which is counterproductive. We want to make rational decisions that positively affect our investment returns, but we see that our biases and our emotional, when we take decisions that are driven by our emotions or cognitive biases, we take suboptimal decisions. Now, I will also cover some of the other cognitive biases that are prevalent. One of the most common one, or the one that affects most of the investors, is the loss aversion. Now, according to prospect theory in behavioral economics, the human brain does not perceive a loss the same way it perceives a gain. Now, the pain of a loss is much more than the pleasure that the human brain receives by accepting a profitable trade. So it will try anything to avoid losing trades. So fear of losses is felt more intensely than potential gains, which leads to irrational decisions. So what are the irrational decisions? So holding on to losing trades, we already looked at it. It is an irrational decision because it maximizes our loss. And it also, the other thing is that we tend to sell winners too quickly. Like, we tend to feel good when we have a winning trade. We don't want to give up the paper profits, so we want to quickly book our winners. So selling winners quickly is also a very irrational decision. And when we are given a choice, like from the experiment, when we are given a choice between choosing a winning trade to sell or a losing trade to sell, most of the humans or irrational behavior results in us selling winners while holding on to losers. So that is loss aversion. Now the second bias is confirmation bias. So this is also very prevalent among investors or traders. So this is when we are in a bad trade. We tend to seek out information that confirms our existing beliefs, and at the same time we try to reject any information or any data points that contradicts our existing beliefs. So when we are in a bad investment, we tend to seek out information that confirms our existing belief. So this is usually because of confirmation bias. Now another bias is the anchoring bias. So relying too heavily on past reference or a single piece of information to make our investment decisions. Now this is also very common among investors. Like what happens is that when they have a profitable trade, they think, okay, this has already gone up so much, it can't go any higher, and then they try to sell the winners. So they are influenced by what has happened recently, and the counter argument is also like affects us, because when a stock is falling, they think that they cannot go any further, and then they try to either hold on to the losing trade, which maximizes their loss, or in the worst case they also try to average down, like okay, they think that it cannot go further down, and then they try to buy more and more into, so they are adding more fuel to their losing trade, which is also a very bad decision for your investment returns, or it's very counterproductive, or it's very it negatively affects your portfolio returns. The fourth one is post-purchase rationalization. So after making an investment decision, humans tend to justify their choice by selectively remembering. So this has happened. There are also a number of experiments that has shown that how humans tend to rationalize their decisions. So when they have an investment decision that goes bad, they try to look out for any positive information about what the analyst is saying, or they look for news channels, and then they try to seek out information that tries to rationalize their purchase decisions. Even though if it's not a good decision, they try to rationalize their decisions. So this is called as post-purchase rationalization. So in this video, we looked at how the human brain operates in a dual system decision making mode, that is system 1 decision taking mode, and system 2. System 2 is more beneficial for us, or it results in more rational decisions. But when it comes to money, when it comes to finance, when it comes to making investment or trading decisions, the system 1 takes over, mainly because of the emotions, and it's mostly driven by our emotions and cognitive biases. So one way is to recognize that our human brain has these limitations, and we have to overcome these biases by having a proper systematic plan, or having a proper trading plan or an investment plan, and we need to follow that plan to avoid system 1 from resulting in us making any irrational decisions or counterproductive decisions. Hope you found some value in this video. I'll be sharing more videos on investing and trading in this channel. Please do subscribe to this channel. Thank you for watching.